I'm about to be 59 years old. I've been a member for a little over a year, just had my 1-year anniversary. I'm using the 55 to 65 investment model. For the past year, I've been dabbling a little bit and putting some extra money in and that kind of stuff, but I'm really ready to change the way I do my 401k because I've been putting extra into the 401k above the company match, and I really just want to be more convicted and be biblically responsible and start taking any extra money I'm putting into my 401k and start putting it into the model. A little additional background. I've been putting money into the Roth version of the 401k since my company has had that, and I think about 34% of my contribution in total is now in a Roth, and the rest is in a non-Roth 401k. I have a non-qualified, just basic investment account with Fidelity today that I have some small money in, but I want to start every 2 weeks of a paycheck taking the extra money and putting it somewhere, following the model so I can be biblically responsible. So my first question is, should that be in a qualified or non-qualified account? And 2, is it okay to buy individual stocks every other week? I think I've heard in the past you kind of almost are against kind of averaging into stocks like that so frequently, but I'd just like some direction on that.
Sure. So I think it should be a non-qualified account because the 401k, both the pre-tax and the after-tax or the traditional and the Roth versions are both considered qualified money because qualified money is accounts that qualify for special tax treatment because the government said so. So I like the Roth option better than the traditional option. So I'm really glad to see that you're doing that and building up your percentages there. I'd like to see you increase your diversification between types of accounts by adding a non-qualified, which would just be an investment account. So you don't get a tax deduction for putting money in there, but that's okay because I think taxes are going to be higher in the future than what they are today. I don't know what your personal tax bracket is, but you know if you're in the 12 or 22 or maybe even the 24% bracket, I would suspect that taxes are going to be higher or at least the same down the road when you go to start taking money out. I would probably focus, if you don't have the ETF positions or the mutual fund positions, those are better to dollar cost average into. You may or may not be able to dollar cost average into the stock positions, maybe even the ETF positions based on the amount of money that you're putting in. I would just check with the platform that you're using because they may or may not let you buy fractional shares. So, for example, if you're wanting to buy a share of stock that's $100, but you're only putting in $50, you have to make sure that the platform will let you purchase a fractional share.